Hello, everybody. Welcome to our latest ADIT Gulf States Network webinar for our growing community of ADIT students, graduates, and affiliates across the GCC countries. It's my pleasure. My name is Rory. I'm the ADIT manager at the CIOT, and it's my pleasure to be with you today introducing this exciting session. We have two expert speakers joining us, along with our ADIT champion for the Gulf States Network. Our two speakers today are Mariia Merkulova and Joo Whan Lee. Mariia is a corporate tax specialist with more than 10 years experience in complex international corporate tax and withholding tax issues. She has worked for Big Four firms in the UAE and is currently a tax director with the National Marine Dredging Company. Mariia has experience in a range of energy projects, including oil and gas and renewables across a range of jurisdictions. Her work has encompassed multiple tax streams, including tax structuring, group optimization projects, tax due diligence, and financial model and transaction documentation reviews. Prior to her relocation to the Middle East, Mariia worked with Grant Thornton and DTEC, Ukraine's largest national energy group. During this time, Mariia's core areas of expertise included the tax implications of inbound and outbound investments, and she also reviewed loan agreements for repatriations, audited and led a group restructure. Joo Whan is the Korean Services Group Senior Manager with more than 15 years of client servicing experience in professional tax services in the United States, Korea, and the Middle East. As a regional leader of the Korean Services Group at Deloitte, Joo Whan forms strategic alliances cross functions to ensure a consistent and focused support for Korean corporations' business expansions across key markets in the Middle East. He has provided tax consulting advice to several leading global Korean companies in the Middle East, including advice with respect to tax compliance considerations, international tax issues, and tax controversy matters. In addition to achieving the ADIT qualification, Joo Whan also holds a BSc in accounting and finance from Syracuse University in New York and a master's degree from Rutgers University, New Jersey. He also holds US CPA license in the state of New York. Both Mariia and Joo Whan are proud ADIT holders, having themselves completed the qualification and enhanced their international tax careers. I'm also joined today by Anas Salhir, our ADIT champion for the Gulf States, and I'll be handing over to Anas shortly. However, before I do, just a little housekeeping. We will be having a Q&A session at the end of the webinar. So if you have any questions for our speakers, please do type them in using the Q&A box. You can do that at any time during the webinar. And at the end, we'll collate all of the questions and we'll deliver those to our panelists. So if there's anything that you'd like to know more about or on any of the topics that are discussed, any questions as to how it kind of would impact upon you or your particular interest, please do share those questions and we'll be happy to answer them at the end. So without further ado, over to Anas.
Great. Thank you very much, Rory. And I'm not going to take much of the time of the presenters. I think there's a lot for them to address in this session. So I wanted to thank everyone who's attending. I think we have a lot of attendees who are coming in. Again, as an ADIT community, we need to grow the practice in terms of taxes, to grow the awareness, and to hopefully support the tax market to grow within the region. So again, this is one of the first sessions that we're addressing a specific country in the region, and hopefully there's much more to come, addressing it from an international perspective, from a local perspective, how things are going. And again, I think UAE is being a hot topic for the region, and that's why, we should be, as an ADIT community, we should be one of the leaders in these kind of webinars. So thank you, everyone. Mariia and Joo Whan Lee, thank you very much also. So I'll hand over to Mariia to start the presentation. I'm not going to take much of your time. So best of luck. Thank you, guys.
Thank you so much, Anas and Rory, for the brief introductions, and greeting to everyone. Good afternoon and good morning for someone from Abu Dhabi. Just wanted to check if you can hear me well now. Please let me know. Yeah, okay, sounds good. Then we will start. So just wanted to share the news, which I think you have heard already, that United Arab Emirates have recently introduced corporate tax, and it was issued on the 3rd October 2022 and published on the 10th of October 2022. Corporate tax law is expected to be applicable to tax periods which will start on or after 1st June 2023. So for example, for some companies which have financial year end starting from 1st January to 31st December, the first year of corporate tax when it will be applicable will be from 1st January 2024. Just wanted also to highlight from the very beginning that the purpose is to provide some overview of corporate tax. Many topics which will be discussed during this session would, of course, require deeper analysis and can by themselves take a full 1 hour to investigate any of the topics. However, the purpose is just to give the general overview and the case specifics of the corporate tax law in the UAE. So I'll start with the first slide to guide you on the topics that will be covered. It will be about persons which are subject to corporate tax, about persons who are specifically excluded or exempt from corporate tax. We will discuss tax grouping, tax losses carry forward. We will discuss the basis of calculation of taxable income. We will get into details of the expenditure which is considered as tax deductible and not tax deductible, and overall some high-level overview of computation of taxable income. So when we want to understand who is going to be the person subject to corporate tax, of course, it will be any legal entity which is incorporated in the UAE, including mainland and free zone. For those who are not aware, I just wanted to very briefly say that historically UAE has developed more than 40 free zones. I think it's around 45 or 46. And this is because there was a requirement that should be the local partner. And in order to stimulate the investment into the country, multiple free zones have been introduced, and which historically could allow 100% of foreign ownership. And therefore, such businesses coming to UAE could get more comfort with having 100% ownership and without need to share it with some local partner, which they would have to find in case they want to establish in the mainland. And historically, for such free zones, there was a requirement to do business only within the free zone or with outside UAE, but not with the mainland UAE. Other legal person which can be subject to corporate tax would be those which are incorporated outside UAE, but effectively manage and control in the UAE. My colleague Jan will provide more details about international aspects of corporate tax. That's why I won't speak about these in detail. If we can please go to the next slide. With regards to the free zones, I have already provided some background why these are in such huge amount in the UAE. Also wanted to add that there is a specialization between different free zones. For example, some are dedicated to industrial activities, financial activities, so different type of activities which can be executed within the free zone. And if income will qualify as qualifying income, it will be subject to 0% rate. Because there should be some, reliance on the legislation which was issued before, and companies should enjoy 0% as long as they would still qualify for qualifying income. Such free zones would still need to meet the regulatory requirements in the UAE to meet economic substance and not to conduct business with mainland. So it will be mainly those which, let's say, do trading activities with outside UAE or with other free zones, but don't generate any income from the mainland UAE. Specific conditions for such qualifying income and for qualifying free zone person will be prescribed by the cabinet and by the Minister of Finance in the UAE. But it doesn't mean that those free zones which qualify for 0% rate would not need to register for corporate tax. They still have to file the registration, and they will have to file the nil declaration. And also wanted to mention about any type of income which will not qualify under qualifying income, and by law it will be taxed at 9%. I think it might be a lot of complexity in case a specific free zone will generate two types of income. One which will be subject to 0% rate and another one which will be subject to 9% rate, because it will require specific accounting complexity to calculate the qualifying income and exempt income, and more specifically might be difficult to do the allocation of expenditure such as overheads between the two types of income. And maybe because of this, the law also gives the option to elect to be subject to corporate tax at 9% for such entities in full. With regards to other persons which can be subject to corporate tax, these also would include natural persons. If we can go on the next slide, please. It will also include any natural person who will conduct business or business activity. The law and also the guidance clarification which was issued with regards to the law provides the definition of the business activity, which is regularly ongoing or independent, or any type of activity, commercial, agricultural, industrial, professional, or any other activity, which will have either continuous nature or for the specific period of time, and which is of course targeting to generate profits. At the same time, it will not lose its identity as a business activity in case it does not make any profit. And therefore, any type of freelancer, sole establishment, partners of unincorporated partnerships will be subject to corporate tax. If we can move to the next slide, where I have highlighted some examples of partnerships. And just very briefly, I think this is in line with many other countries. Any type of partnership which doesn't have a legal personality and has partners, for tax purposes will be seen as transparent entity, and therefore it will be looked through and its partners will be subject to tax. It's quite common in the UAE that not only physical persons but also legal persons can be partners to such unincorporated partnership or unincorporated JV, which are consolidated together for the purpose of specific project, for example, or for some time only to execute this project altogether. However, there will be an option for the partnership or for unincorporated joint venture to apply to federal tax authority and to become taxable person and to be subject to corporate tax in the UAE. It's important to highlight that in any case, such unincorporated partnership or JV will be jointly or severally liable for corporate tax payable on behalf of such partnership. Also, law mentions different type of partnerships, including the family foundation or family trust. If we can move to another slide, please. And just by default, such family foundation or trust will be treated as unincorporated partnership upon meeting certain conditions. The key requirement, and not only to the person or to the partnership, but overall will be to make sure that there is no anti-tax avoidance and that the activity is genuine and not for the benefit of getting the corporate tax exemption or any benefit for tax purposes. And therefore, for example, if family foundation is set up in order to manage real estate or investments of the family, and especially in this region, some families are include multiple family members. For these purposes, there is specific provision in the law that they can be also tax-free as long as they meet the requirements. If we can go to the next slide, where I have outlined the different examples of exempt persons. I think it's similar to other countries and tax laws. by default, government entity is considered an exempt person. It wouldn't need to do any application to be exempt from corporate tax. Government entity is usually involved in legislative, regulatory, administrative, executive, or any other powers or functions which are critical for the entire government and for the society. And accordingly, it's exempt person and it's not subject to corporate tax because there is no beneficial ownership as a specific individual. Its entire government will benefit from their activities. Another type is government controlled entity. Basically, it's an entity which is directly or indirectly wholly owned or controlled by a government entity. But in order to be qualified as government controlled entity, this entity needs to be listed in a cabinet decision. So it's not automatic for the entity. And also any other person engaged in extractive or non-extractive business activities. I just wanted to say that it's quite common in the UAE that each emirate has issued its tax decree, for example, income tax decree of Sharjah or of Dubai, and activities of extractive businesses, for example, exploration, development, or production of natural resources like oil and gas, usually regulated by the fiscal letter, which is issued by, for example, Abu Dhabi government or authorized authority, or by the concession agreement. Under such agreements, these participants, such persons who are engaged in these activities, already paying tax at pretty high levels, and therefore not to create any sort of double taxation, they are completely exempt from corporate tax in the UAE. In practice, it may happen that such entities would also do some additional activity alongside the main extractive business or non-extractive business activity. For example, to rent out some equipment or properties which are within their discretion, or for example, if they have any excess funds, they can do some intra-group financing. But the condition for such other activity to be considered as supplementary or incidental or ancillary to the K business is that revenue from such activity should not exceed 5% of overall revenue. Just in case that there is actually the other activity which is not supplementary, then I think such parties will keep dual status for corporate tax purposes. So for extractive and non-extractive businesses, they will be exempt, and for other activities, they will need to do separate accounting, calculation of taxable income for corporate tax purposes, and so on. Other persons provided by the law include qualifying public benefit entity, qualifying investment fund, and public or private pension or social security fund. In most of cases, these also have very important function for the society, like charity, religious, artistic, sports, healthcare, anything which will be public benefit entity. However, these would need also to make an application to be treated as exempt from corporate tax. They also shouldn't be involved in any other business activity. They can do some activities which will be secondary or ancillary, for example, having a canteen within the charity organization. However, it will not be considered a separate business activity. With regards to investment fund, the treatment is similar how in many other countries. This is in order to facilitate the neutral conditions and equal conditions for all investors, whether inside country or outside country, and it may be treated as exempt entity, like unincorporated partnership or GV, in the same way. I also added here the non-resident person who is involved in operating aircraft or ships in international transportation, but this exemption will be only given in case a reciprocal treatment is provided in the country for the tax resident of the UAE for the same activity, which needs to qualify for international transportation of people, of cargo, and so on. If we can go to the next slide, please. I think this is in relation to the previous slide, the I have indicated the persons which are fully owned or controlled by UAE subsidiaries of government or government-controlled entity or qualifying investment fund, public-private person or social security fund, or any other authority which will be specifically prescribed by the cabinet decision. And this is only in case such subsidiaries undertake partially or in full the activity of exempt person, or if they are engaged exclusively in holding assets and investing funds for such exempt person, or if they carry out activities that are ancillary to those activities which are carried out by the exempt persons. In case they don't meet the activity, they will not be considered exempt, and it will be at the discretion of the ministry whether to keep the exempt status in case they stop meeting the prescribed conditions throughout the year. But in case they will decide to withdraw, to revoke such exempt status, it will be done from the beginning of the period, just to make sure that there is no difficulty when if this happens throughout the taxable period. If we can go to the next slide, please. I have outlined the tax group key considerations. The important condition is that it should be between the tax resident legal persons, and any person which is qualifying free zone or which is exempt from corporate tax cannot be part of the group. The shareholding requirement is also important. It's 95% directly or indirectly. And such entities of the group should follow the same financial year and use the same accounting standards. In UAE, most of entities, as far as I know, using IFRS standards, but financial year may vary from entity to entity. Main consequences of having a group is that the group will need to file only one tax declaration and only one financial statement for the entire group. Any transactions within the group can be treated as tax neutral for tax purposes. For example, transfer pricing is also introduced in the UAE together with corporate tax within the same timelines, but it can be disregarded for any transactions between the members of the group. It's not directly prescribed by the law, but it was clarified in one of the frequently asked questions on the website of the ministry. And also, it's beneficial to have a group in case of utilization of losses, for example, generated by one person and then given to the group. So a lot of benefits actually to get into to consider tax grouping for big groups in the UAE. If you can go please to the next slide. Here I have outlined the key features of tax losses. Tax losses can be carried forward as in many other jurisdictions. There is no carry back of tax losses. So once suffered in the relevant tax period, they can be carried forward to the future period. It's in case if expenditure is exceeding the revenue. There are some conditions for utilization of losses available. It's only up to 75% of taxable income. So for example, if taxable income is 1 million, then only 750,000 can be losses can be offset. There are some specific requirements for change of shareholding and change of control, and also to continue the similar business activity. Same like in other countries. However, there is exception for listed companies. They don't need to prove the change of, even in case of change of ownership of activity, they will be able to utilize the losses. Some conditions when losses cannot be utilized, and those which incurred before effective date of corporate tax. So for example, for those whose financial year is 1st January to 31st December, any losses before 1st January 2024 cannot be included, only after the first tax period is over. It also cannot be incurred before the person becomes taxpayer. And also shouldn't be included tax losses from activities or assets which generate exempt income, basically those which are not involved in business activity. If we can go to the next slide, please. Yeah, UAE basically combined the both principles for taxation, residence and source, and resident person will be subject to tax both on income which is derived from UAE as well as income derived from outside UAE. Regarding non-resident person, my colleague Jan will cover, so I'll skip this one. The key features to consider, the key considerations is that all type of entities should be subject to corporate tax, except for unincorporated JV or partnership. Unless the election to be subject to tax is made. The tax base is pretty standard one. It's net accounting profit, and then specific additions and deductions to arrive to tax base. Tax rate is 0 for qualifying income of qualifying free zones and 9% if the threshold is exceeding 375,000. Or if we can please move to another slide. So basically any taxable income below the threshold of 375,000 will be zero rate. And the tax year, it should be the same as financial year. The declaration is filed once a year. There is no requirement for any provisional returns or advance payment of corporate tax. It's a self-assessment basis which should be done at the end of the 9 months of the following year from the end of the taxable period, which is in line with financial year. If we can go to the next slide, please. So here I have included basically all key additions and deductions which should be made in order to arrive to taxable income. So we will take net accounting profit loss, and then we will need to deduct any income which should be tax-free. The law also indicated that those entities who follow accrual basis for financial statements purposes, there might be some unrealized gains or losses, including the gains or losses from foreign exchange transactions. So the taxpayers will have an option to choose that they can tax this based on when the realization actually happens. So for example, when the asset was sold, or so they can choose this for the assets and also for the revenue items. And basically the difference between capital account is that it's for long-term purposes of business, for assets and liabilities which are on the balance sheet, and for revenue account is those which are for short-term, like trading or inventory and so on. The other tax-free income should be participation exemption, dividend, capital gain, pretty similar with what we have under parent subsidiary directive. Then foreign permanent establishment exemption. It means the taxpayers will have an option also to choose whether they will tax the income of a branch which is registered abroad. And in case, so basically they can select to tax it, and then they will be entitled to enjoy the foreign tax credit for the tax paid by such branch overseas, or they will exclude it from calculation of taxable income in the UAE. Also gains from transfers within qualifying group and gains from qualified business restructuring is such as mergers, demergers, when, for example, the ultimate shareholder is not changed. So these sort of transactions can also go tax-free. Non-deductible expenses, those are mainly those which are in relation to an exempt income. The key condition for expenditure is that it should be wholly for the purpose of business activity. So when income is exempt, then expense will be non-deductible expense. Then there are some interest limitation on EBITDA. General rule, up to 30% of EBITDA can be deductible interest. entertainment expenses, any fines, penalties, taxes settled in foreign jurisdictions, recoverable VAT, corporate tax paid, and so on. Also such distributions, profit distributions like dividends, or any other distributions of similar nature, and adjustments for transactions with related parties, and any other expenditure which may be prescribed in cabinet decision which will be issued. If we can go please to the next slide. I already highlighted the key features for deductible expenses, that these should be wholly exclusively for purpose of generating taxable income. So I think I'll skip this slide. Let's move to the next slide. With regards to interest limitation, it's 30% of EBITDA. There are specific interest deduction rules with regards to any financing or loans between the related parties. I think mainly these are in line with international rules, and in order to prevent any tax avoidance, for example, to obtain the loan from the bank and then transfer it to related parties to deduct interest, and then to distribute such loan for the purpose of payment of dividends or injection into equity of a subsidiary, and so on. As long as taxable persons in the UAE can prove that such transaction is made for pure commercial or business reason, then this, upon discretion of the tax authority, they may still pass the test. If you can please go to the next slide. Participation exemption is similar. This is on overseas shareholdings. Requirements are very similar to parent subsidiary directive, minimum participation of 5%, which will allow the shareholder to get the profit distribution or even liquidation proceeds in case of liquidation of such subsidiary, 5% and higher. There should be actual holding, or even it's allowed to have an intention to hold for 12 months in order to pass the test. And the requirement for the subsidiary that it should be subject to corporate tax in a foreign jurisdiction at tax rate not less than the one in the UAE. And also there are some other specific anti-avoidance rules prescribed by the law to meet the participation exemption test. If we can please go to the next slide. Here I just wanted to outline, I think it's very common for many countries that any entertainment expenditure is either not deductible in full or partially not deductible. So the UAE went the same way, and any entertainment of the customers or shareholders or suppliers or any other business partners will be 50% disallowed. This will include any spending on the meals, accommodation, transportation, any admission fees, tickets, facilities, and so on. The important is that there is no limit on any entertainment for employees, for the staff, which therefore should be fully deductible. And also any VAT which is suffered, for example, on entertainment, and in case it's non-recoverable. So basically non-recoverable VAT on any type of entertainment will be fully tax deductible expense. If we can please go to the next slide. I just here outline the computation that once the computation is done, then we can consider carry forwarded losses to reduce the taxable income up to 75%. And we need to make sure we will deduct 375,000, which is of taxable income, which should be subject to zero rate, and then we will arrive to the tax due. There is no withholding tax. Actually, there is withholding tax at 0% rates in the UAE, and there will be possibility to avail the credit for tax which is paid in overseas jurisdiction. Withholding tax, for example, of subsidy on any distribution from withholding tax which was suffered in a foreign jurisdiction by the tax resident of the UAE. I think that's it on my end. I would like to hand over to Jan, who will provide some highlights on the international tax aspects of corporate tax and also on transfer pricing. Thank you so much.
Thanks, Mariia, for your part of our presentation. So I will present for the international tax aspect, which is covering the UAE law. And pretty much briefly, I think for the international tax aspect, I think it's pretty much UAE law is in line with the OECD model tax convention. So I'm going to go each slide to go over. So when a non-resident can become a taxable person, so non-resident, corporate tax should be imposed to non-resident person that has the PE in the UAE. So taxable base will be taxable income attributed to PE, and drive state source income, UAE source income not attributed to PE, and has a nexus in UAE. So tax basis will be taxable income attributed to nexus. So Netherlands, foreign legal person effective management and control in the UAE, tax basis will be worldwide income. Next slide. So it's very interesting also see it covers for the nexus. So on the Article 11 OC covers non-resident person should be subject to UACT if it has the nexus in UAE, specific decision issued by the cabinet. So the main point what we can discuss is so what do you mean by nexus? I mean, I think from edit study material we covered nexus. Nexus meaning is very broad. It can be covered with the digital tax and the Pillar 1 initiative. But it covered the nexus in the UACT law. And last week, tax authority issued the explanatory guide of the UACT. The guide states that cabinet decision might prescribe other circumstances in which a person that is not a resident person will become a non-resident person by virtue of having nexus to the UAE. This clause allows the cabinet to determine the person can be the non-resident person. As such, within the scope of the corporate tax through some other forms of the connection to the UAE. So I think it's very important to highlight that mention about through some other form of the connection to the UAE. And then P also exists if the non-resident person has any other forms of the nexus to the UAE and might be defined the cabinet decision. And this cabinet provides the flexibility to determine the person can be PE in the UAE through any other economic business links to the UAE that is considered significant to bring such a person within the scope of the corporate tax. So company to modify the issuance of the relevant cabinet decision as once the meaning of the nexus is clarified. Next slide. And if we're looking at the non-resident source income, so under Article 11B, non-resident person should be subject to UAE CT if it drives the state source income. So it lists down all the source income, which is sales of the goods in UAE, service rendering happening in UAE, contracts enter related to the income, and movable, immovable property, and disposal of the sales, intangible property, and interest, income, and the delayed insurance. So, the law is give a lot of the extensive list of the source income, which means non-residents have such a source income is subject to tax in the UACT law. And the guide provides the example. The dividend income is sourced in the UAE, where the payer of the dividend is residents in UAE for the corporate tax purpose. It is intended to be including the income, which might be specific in the implementation decision that being subject to corporate tax in form of the withholding tax under Article 45, which is Article 45 is about withholding taxes. Then characterization of the income as income from the business, and the business activity does not describe the income depending its nature of the characterization as the state source income and the application of the withholding tax. Then it mentioned that to the time of the enacting of the corporate tax, the application of the withholding tax is 0 rate. So even though you have the source income in UAE, and then as a non-resident, then withholding tax will be 0 rated. So, but withholding tax will be changed throughout the cabinet decision. So those I think is pretty much in line with the international tax standards. And next page, please. And for next part, I want to go over with the PE, Article 14 of the UACT law. And non-resident person has a PE in the state, and the following instance, where it has a fix of the permanent place in the heaviness immigration authority to contract the business and activity in the state on behalf of the non-resident person, and then other form of the nexus. So if we look at the OECD Model Tax Convention, the type of piece on the MTC is a fixed place and the construction, agent, and service. And the fixed place of the business, P Article 14.2, the fixed place, permanent place is as follows: place of the management, branch, office, factory, workshop, land, and here there's additional of the installation and structure of the exploration of the renewable, and then all non-renewable nature of the source. I think this is included on the below as well, mine, oil and gas, because Middle East, I think there's a heavy industry related to the oil and gas. So that's the only part I think is the additional, the OECD convention model. Next page. And then construction PE, there's a close of the construction PE. It will be PE if we have more than 6 months within our construction activity. This is not in line with the OECD convention, which has moved last more than 12 months. But this is more aligned with the UAE NTC. And then also there's an exemption for the preparation anxiety activity, and also is in line with the OECD MTC, and also anti-fragmentation notice assigned aligned with the OECD MTC. So then agents PE also is covered Article 14, 5 and 6. So top person ability conclude the conclusion on behalf of the non-residents is a similar wording of the OECD MCT. Next slide. And then there's an exemption of the nature person covers under Article 14 and 7. So if you are merely just presence of the natural person in the state, does not create PE for the non-resident person. That mention is it has to be temporary and exceptional situation. And this temporary exception situation also the tax authority FTA, the federal authority, released the ministerial decision what will be the temporary and exemption. And then where the natural person is employed by the non-resident person, if it's that be not the core income and does not drive the state source income. So, and I think that if we can look at this situation, and then what if this employee of the headquarters for the person, visiting to the state just for the general meeting, not negotiating the contract. This can be applied for the this exemption situation. So we just have to look more classification on this part. And then interpretation of the PE definition. So the guide covers about this as well. So the definition of the PE in the corporate tax law follow the principle provided in Article 5. OECD Mother Tax Convention on Income and Capital, and non-resident person might consider the principle and the relevant provision of any bilateral tax agreement between the countries and residents of the non-residents person in UAE. So I think the both states have to be agreed, about 183 days. It can be the temporary threshold. So I think this have to leave it to the two states. The next state. So then I'd like to touch upon here about the attribution of the profit to the PE. So it does not clearly cover, but however, Article 24, the foreign PE exemption, explain how to split the profit between the residents and the foreign PE, and then determine the income and associate expenditure of the foreign PE and the resident person. Each is foreign PE should be treated as separate and independent person. So this had to be separated as a foreign PE. And independent person, we have to look at as independent person, and the transfer of the asset and liability have to be, taking place as a market value. And then I think then we can look as a attribute of the profit to PE, and then we can approach the authorized OECD approach, allocating the profit between the different part of the enterprise under the fiction of the PE or the distinct and separate entity, and to the which is arm's length standard applied. And there's a two-step process, which is the functional analysis, functional risk asset, and then numerable of the PE at the arm's length. And the registration of the tax purpose, so submission of the tax return and the payment tax within 9 months from the year end of the fiscal years, and then having a separate financial statement to be submitted together with the tax return. I think this just announced that if you have a revenue of the 50 million dirham, then you need to prepare the audit financial statement. Also, so if your company based in the region, also need to have an audited financial statement. So, yeah, next slide. So I want to touch upon here respect to the TP. So TP is covering the Article 34 and 35 in the UACT law. And the arm's length principle, TP rules are introduced and ensure that transaction between the delayed party and connected person, domestic or cross-border, carry out the arm's length term. So also delayed party states that the individual entity who has a pre-business relationship with the business that within the scope of the UACT regime through the ownership, control, and cashier, partnership, trust, founder, the beneficiary of the trust or the foundation of the P. So under the control, ability of the person by the right and agreement to influence another person by exercising the voting right, determined by the board of the director, receiving the profit and influence or controlling the business of the another person. So there's a control person and a different form of the related party, including the owner of the business, director of the owners, and the business, or the related party, either one. So, the payment need to be at the market value. So, the law covers the offsetting TP method is the CUP, resale method, resale pricing method, cost plus TNMA, and the transaction profit split method, and other methods. So, and then APA will be possible. So maintaining the master file, local file, the total consolidated group level, which is 3,100 million dirham, which is equivalent to the 73 million euro, and then taxable person revenue in UAE is 200 million dirham. So, and if I look at here, I think it becomes more importance of the TP documentation now. I think also pillar 2 is introduced of the now most of the country now. If I look at the Korea introduced the pillar 2 starting from 2024 with the income inclusion IRR. So if let's say UAE foreign company based in the free zone, they are subject to 0 rate of the corporate tax. But if you're looking at the pillar 2 perspective and the home country, they introduced the IRR, then from 2024, then there will be the copper tax. The 15% will be going to Korea, whatever income is made in UAE. So I think then from the TP perspective, I think UAE company, the foreign company, have to look at the there are many distributor entity here. They do a lot of sales marketing function. So I think they have to see how much income had to be attributed in UAE by using different TP method. So I think TP will be getting more in deeply. They need to get a study done. So along with the pillar 2 impact. Okay, so next slide. Yes, so place of the effective management. So the residence of the foreign legal person effective management and control in the UAE. Then tax basis will be worldwide income. So place of the effective management control. There's a 2 approach internationally applied, and then manage and control tests where the high level decisions are taken, generally where the board of directors is local and need to consider and make a strategic decision related to the company business. And the effective management test is where the day-to-day activity are carried out, generally where the person authorized to represent the legal entity carry out the day-to-day management activity in Cuban up and down. So where the management director works on the daily basis. And then last week, when this explanatory guide released, they cover about this place of the effective management. What they're saying is the foreign entity could have multiple places of the management in different locations, but generally only one place of the effective management control for the purpose of the Article 11.3b at any one time, which is where the strategic decision and power regarding the management of the entity as opposed to the day-to-day operation are regularly, predominantly exercised. So I think this will be place of the effective management. I think when this UACT law is introduced, it's for the purpose of having effective management and control by the entity should be had by the foreign legal person. So next slide. Next, yeah, you can go next slide. So I will touch upon the general anti-avoidance law in the UAE. So the PPP, I just gave an example. So Mariia Merkulova's earlier slide is a participant exemption when the dividend income will be exempt by the subsidiary. But if that condition is not met, then if you don't have a proper tax planning, then the foreign dividend of the this example we put the 600,000 will be taxable on the 9%. Okay, then there's a next one. If you look at it, there's a scenario 2. If you obviously tax planning making it because of the tax will be 0 rated up to the taxable income is the 375K. So if you want to split the 2 entity by having a dividends of the 3,000K to apply this benefit for 0 rated, this might be triggered as a general anti-avoidance law. So Then main purpose of the consideration, the following elements should be analyzed under Article 50, clause 1A, transaction entered not for valid commercial or other non-favorable reason which reflects the economic reality, and then presence of the city or advantage. And where the PPT applies, the authority might define that the tax obligation should be contract and then adjust. Okay, so I think pretty much this is all the slide I'm covering for the international tax aspect. But when I studied the principle of the international tax, the paper, I think very helps to understand all this UACT law, and very much is in line with the OECD Model Tax Convention. And so this is what I see from my view. So, and I think this is what I cover for my part. So next slide, I think we have a Q&A session.
Thank you very much, Joo Whan and Mariia, for your excellent presentations. We would like any questions that any of our viewers may have, any of our audience members may have. Once again, if you just drop your questions into the Q&A box, that then we'll be able to ask our two speakers their respective questions. Okay, so we have one question in from Dinesh. What is the definition for qualifying income?
Mariia, I think you can answer for that part.
Yeah, a specific definition for qualifying income will be provided by the Ministry of Finance. Overall, I can say that these would be the transactions which are not generating income from the mainland. So in order to meet the requirement of qualifying income, the free zone entity would need to do the sales or provide services to either overseas entities outside UAE or other free zones, but in no case it should be income generated from mainland, because otherwise various tax avoidance schemes may be implemented, because income generated from mainland will, if we assume it's subject to 0% corporate rate in free zone, but someone who paid this, it will be expenditure, it will be fully tax deductible in the mainland, and that's why.
Thank you very much. Hope that answers the question, Dinesh. And question from another Mariia. If someone is a freelancer and that person's income is income from the investment in cryptocurrencies, in crypto exchanges, then would that income from that activity be considered UAE source income?
Yeah, I'm not a specialist in crypto. I can provide the generic response that in case business activity is undertaken, then it will be subject to corporate tax. If it will qualify under qualifying income within free zone, in case this person is registered as entrepreneur, then it will be subject to 0 rate. If it's mainland, then it will be subject to 9%, as long as there is business activity.
Thank you.
I think I can add that for freelance, I think that also it is on with the condition of the small business relief. I think there's some condition met if it is still under the small business relief, then I think get the exemption of the tax. So I think, but there's a revenue threshold and so on. So I think you can put it together with the freelance.
Fantastic. Thank you both. And another question from Dinesh. If a free zone entity generates both types of income, i.e. within free zone and mainland, how will they split the revenue and related expenses, and how will the tax base be determined?
Basically, it will be quite complex and not straightforward, because they would need to do separate accounting and probably select some allocation keys to allocate, for example, overheads between expenditure which will be exempt and which will be taxed at 9%. So it will require some calculations and maths, and there might be more challenges and scrutiny from the tax authority on this allocation of overheads or expenditure between two types of income. The same would be similar in case of any exempt person who is involved in other business activity. They will need to do the same. Actually, for the other business activity which is not exempt, they need to maintain financial statements, to allocate the overheads expenditure correctly, and in order to calculate taxable income in the right way, in line with the law.
Terrific. And question from Joseph. How is the DTA, the double taxation agreement, applied or considered as far as the new UAE corporate tax provision is concerned? Not sure which was specifically, but whether there is a specific DTA with another country that Joseph, you're referring to, or if you're talking kind of generically.
I think because I think when the UACT is introduced, before that, I think because there's already double tax agreement placed UAE and other countries that already previously. But if I give one example with Korea, I think 2021 they revised the agreement more in line with the OECD standard. So I believe many of the other countries bilateral they make a update agreement, so it doesn't much impact to other country when the UACT is introduced. So I think, but we have to looking at the different country how they agree this double tax agreement.
Yeah, and I think maybe Rory, to add from a kind of like international perspective. So the DTTs or the double tax agreements in general, they would do two kinds of reliefs. Let's say whenever you have a PE or whenever you have a source. So I mean, if we recall the principles of international tax, these are one of the things that, depending on the double taxation or the type of double taxation that is happening. So I think UAE is going to be similar, mostly similar to other countries if we take it from that consideration. Where they would provide reliefs. Now, there is no withholding taxes, so mainly we're going to talk about source of income for permanent establishment and to define whether it's residency or source and where it should be subject, attribution of profits, transfer pricing. So, I mean, all of these matters will come into play, I assume. So that's in a generic term.
Wonderful. Thank you very much, Anas. That looks like all of the questions that we have at this stage. So thank you very much to our audience. Actually, we have we got time for one more question. Another question in, is there any possibility that the UAE will adopt the OECD Pillar 2 approach in the year 2024, i.e. the global minimum tax?
I don't know, maybe I'll try to provide my view. I believe that possibility always exists, because if they don't do this, they will give the taxing rights to other countries for huge groups which qualify for 750 million, like and consolidated. That's why I think there is a possibility. It will just depend on the draft legislation once it's issued, and then probably some following clarifications. I heard already that some work is already being undertaken by the Federal Tax Authority, but we don't have the exact timelines. But I think we should all be prepared to get this in 2024.
Wonderful. Yeah, a huge thanks again to our speakers, to Mariia, to Joo Whan, and to Anas as well for his additional insights. It's been a pleasure listening to the topic and learning about the new corporate tax regime in the UAE. We will be able to share the slides following the webinar. But yeah, we always share the slides after each added webinar and a recording as well. So if you want to revisit any of the topics, you'll be able to do that. As Anas said at the beginning, we are looking to deliver more added network webinars for our Gulf States network further down the road. So keep on top of our LinkedIn group, and including our Gulf States LinkedIn group and our website for all the latest details on our following webinars in future. And yeah, well, once again, a huge thank you to our speakers, and we hope everybody has enjoyed the presentations and the session today. Thanks to everyone.
Thank you very much.
Thank you.
You guys take care.
Bye.
Bye.